Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, and this is episode number 90, Bank of Mum and Dad Part 3. There's that disclaimer, all about facts and figures, it's information, it is not advice. Okay, so we've been talking about how can we assist our children perhaps to get into a home, to be able to afford to find their deposit and so forth. One of the things that will hamper them as far as getting loans is concerned, if they do indeed have some sort of a help debt, some sort of uni debt or any sort of educational debt that has to be paid back. Because anything that is a debt, then literally the bank is going to look at that as an expense, and hence their cash flow is down. They are going to limit them to what they can borrow. So perhaps rather than giving them money for the house, you tell them that you're going to pay their uni fees. And if obviously again, if you can afford to do so, it'll allow them to borrow more. But basically what you can be doing here, it is not just a gift for their house, it's more seen as a reward for their hard work. You've seen them slog, you've seen them stressed, you've seen them do all the hard work to get that degree behind them, and effectively you're saying, look, okay, well done, we're going to help you out, give you a bit of a kickstart in your life, and we'll basically pay for your uni fees. Whereas the dollar amount could be, what you could afford, what you're going to do anyway, but it's sort of got a bit of an incentive there behind it. So therefore they're buying their house under their own steam, and it just literally means that it gives them a bit of sense of their own worth, that they've been able to do it on their own, under their own power. Just the fact that we've been able to help them out by getting rid of a debt that they would have had otherwise. I mean, it doesn't have to be a uni debt. It could be a car loan, it could be some other personal debt. But if it's one of those sort of consumer type debts, then obviously if you're going to pay that out, that's sort of almost rewarding for bad behaviour by getting into that debt in the first place. So it certainly would be a case of discouraging them from turning around and doing any more of that type of debt, if at all possible. So yeah, a bit of a lesson to be learnt that, yep, will help you out, but don't just turn around and just get the credit card out and get back into the same sort of situation. You may want to do it as an incentive process, so that if give them some sort of incentive to save. That if you save 20,000, we'll give you 20,000. We'll match it 1 for 1, or whatever you can save, we'll give you 50% or 20%, or whatever numbers I say work for you and for them. But by setting a goal, it's teaching them good habits. You do this, and yep, we'll reward you. And it's not a bad way to look at it. Gives them, they've still got to do the hard work, they've still got to do the saving, but then there turns around and there is this assistance from you. But it's only a reward if they indeed achieve it. Now, of course, if they don't achieve it, you've already paid up some money, then perhaps that money needs to come back. So, it's got to be sort of explained to them how this all works, and you're not just going to give them the money, that it is a reward for hard work and for them saving. And of course, by them saving more, it is good when they go to the bank to show that they actually do have some sort of good savings capacity. A bank will look at what goes into the account. Yes, okay, if you drop $50,000 into an account before they go and see the bank will like having that money there. But if there's been a history of no other further savings, they're going to say, well, okay, you got this $50,000 from parents. Can you save under your own scheme, under your own steam? So that proving that they can actually afford to have this loan sort of going forward. So proving that they can save certainly is advantageous as well from the bank's point of view. Now, probably one of the most popular ways, where if you really don't have the money to give to the kids, that perhaps using some of your equity in your home could indeed be the way for them to avoid having to pay this mortgage insurance. So you're not giving them a gift, you're not giving them a loan. It's really just an ability to use the current equity that you've already got, so that therefore the two of you together can afford to buy this property. Now, so you're not going to be paying for it, it's just the equity of your own home. So let's imagine you've got a home that's worth $1 million and you've got, say, $250,000 worth of debt. You can't really afford to turn around and give the kids money. But you do have $750,000 worth of equity in your home. If the child's new home is $500,000, but they literally just don't have any deposit whatsoever, it literally means that the total value of the house is 1.5, it's the two houses together, and the debt would be the 500,000 of their debt, 250,000 of your debt. We've got debt of 750 against a $1.5 million worth of property. So therefore, the loan to value ratio across the two properties is 50%. Hence, therefore, the kids can get a loan without having to have mortgage insurance because literally they've got sufficient equity. Now, of course, all of a sudden, your house, it's not like you've increased the size of your debt. The debt is effectively against the other home where the loan is, but it basically means that if anything does go wrong, okay, then the bank can come back and say, well, okay, what's happening now is that you've gone guarantor effectively for that amount. So we can have what's called a limited guarantee. So obviously you don't want to be in the situation where the whole of your $1 million house is at stake. And so you can have these family guarantee, parental guarantees and so forth, which is basically a limited amount of risk. So you could say, okay, I'm prepared to put $50,000 equity of our home on the line to get them into their loan. And so you can basically say, yep, $50,000 is the maximum that we are prepared to do. So yes, it's generally speaking easier to work get your kids to come to your bank, the one where you're already at. Unless, of course, they can get a really good deal somewhere else, in which case it may be a case that you're renegotiating a loan with them. Depends on how it's all structured, but talk to a good mortgage broker, the best way to do this with parental guarantees. But you certainly can set up a limited amount. Now, of course, this is only a temporary thing. It's not permanent, because you see, as the value of their house goes up, so initially the house was 500,000. As the value of the house goes up, let's say to 700, gone up by 200, they've paid down their debt by 100,000 or so. Their equity's improved by $300,000, and this is basically you can indeed be removed from this situation. So it's basically saying that the parental guarantee is where the guarantor are the parents. Now, in theory, it can be a different relationship there, but this is basically how it works with either a family guarantee or a parental guarantee. But it's basically, there is a limit that a single guarantee is able to represent no more than 50% of the guarantor's security. So there's a sort of a restriction on this to really ensure that you're not going to put the person giving the guarantor under too much stress. But it literally does mean that we can put a limit on it, and over time, as the debt goes down, the value of the house goes up, you can then be released and you've got no more stress to worry about going forward. And of course, if these numbers were kept to a reasonable amount, and let's say it was 50,000, but you did have a house worth $1 million and you had very small debt on it, using up equity of 50,000 isn't going to be too stressful to a degree where if you did indeed have two other children. So this could be, if you've got further equity and so forth available. So anyway, all of these things, there are obviously lots of pros and cons. There's lots of issues, lots of fine detail to go through. I would strongly suggest that before you jump into any of this, go and talk to a mortgage broker who can really step you through this thing. Explain it. They would have seen it 1,000 times before, but they would know all the tricks, all the ways to sort of look at it to ensure that you as a parent are not being put yourself in too much of a dangerous situation, and of course that it's working for the child and it's flexible. So it's flexible so that it can indeed be unwound down the track. So, yep, it's just it's not a bad little idea. It can work, and at least you're not diving into your own savings to be able to do it. But yeah, certainly want to know the ins and outs before you jump in. Happy to have a chat about it, and of course, look forward to talking to you on another session.